I'm Al Brooks. Thank you for watching the Brooks Trading course. This is a I'm Al Brooks. Thank you for watching the Brooks Trading course. This is a bonus video on trading bear channels. I want to begin by defining a bear channel. I want to talk about bear channels in general, and then there are specific types of bear channels that I think are worth trading differently. For example, a very tight bear channel, for example, what you would see in a small pullback bear trend, or a very broad bear channel. What is a bear channel? Well, this is a channel. We have lower highs, we have lower lows. That is a bear trend, and because we're getting pullbacks along the way, it's a channel. You can draw lines above and below it that contain it, and that might help you think of it as a channel. Every bear trend begins with some kind of a breakout. It can be small, it can be big, it can be multiple bars, it can be a single bar. And a breakout is a sign that the bulls are giving up and that the bears are selling aggressively. There's strong agreement that the price is too high, that the market has to go lower to find a price where the bulls want to buy. I think of a breakout as a trend bar. Every trend bar is a breakout. Every breakout is a trend bar. Most trend bars do not result in successful breakouts. Most of them reverse. It goes up a little bit and then reverses, goes down a little bit and reverses. I use the term breakout for a trend bar or a series of trend bars that has a reasonable chance of beginning a trend. A bear breakout is one or more bear trend bars that are big relative to the prior bars. Here we have a relatively big bear trend bar. Maybe it's the start of a bear trend. On the open, we have consecutive bear bars. One of them is a big bear bar, and it's closing near its low. At that point, the market is always in short. The odds are that we'll get at least a little bit more down. It's possible that it could lead to a trend, and this is an example of a day where we did get a trend from that early bear breakout. A pullback is a bar that has a high above the high of the prior bar. So here we have a breakout. This high is above the high of the prior bar. It's a pullback. Once there's a pullback and a breakout, the breakout phase has ended and the channel phase has begun. When the pullback begins to resume back down, that is the start of the channel. And if you get a series of lower highs and lower lows, you can call it a channel. Sometimes you can draw a perfect trend line across the top, a perfect trend channel line along the bottom, and they're both parallel. That is the exception. Normally, you're going to be thinking about drawing these things with a very fat crayon and assume that they're not going to be perfect. It's still a channel, and you trade it like a channel. Every trend is some type of a spike and channel trend, even though a lot of times the spike is not obvious or the channel is not clear. Typically, a trend will have at least 3 legs, and anytime I have a bear channel with 3 legs, I think of it as a type of a wedge. Sometimes it looks like a wedge, sometimes it does not. It functions like a wedge, whether or not it looks like a wedge. A channel, here a bear channel, it's a bear trend. It's weaker than the breakout phase. The breakout phase has higher probability of lower prices, and a channel has less probability. It's constantly trying to reverse. If the channel is a wedge, especially if it's climactic, it will attract some profit taking, and that could result in a strong minor reversal or even a major reversal. Every trend, every bear channel is constantly forming wedge bottoms. Most of them are minor. For example, here's a wedge bottom. Here's a bigger one, 1, 2, 3. Here's another one, 1, 2, 3. Bear channels typically break above the bear trend line and then the bear channel evolves into a trading range. I think of every bear channel as a bull flag because 75% of the time you'll get a breakout above the bear channel, just like you would with a bull channel. Spike, bear channel, you expect an eventual bull breakout and then an evolution into a trading range. And once it enters a trading range, the market's back to breakout mode. Traders are again waiting for the next breakout up or down. When the market's in a bear channel, it's in a bear trend, it's easier to make money selling, especially if most of the bars are below the 20-bar exponential moving average. Easiest way to enter, you get a pullback and then a bear bar closing near its low. You sell with a stop one tick below those bear bars, and you can do that all day long. You can hold for a swing trade, or you can take repeated scalps. If you take a short, you put your stop above the most recent major lower high. If you take this short, you either put a stop above this bar or one tick above that bar. Same thing here. If you take this short, your stop is below there or above here. If you sell here, a double top, probably okay to put a stop above that or above that. Sometimes there are reasonably good buy setups, but if the channel is tight like this, the reversal up is probably minor. It probably will turn into either a bear flag or a small trading range, like here. What are some of the signs that lead you to think you should only be looking to sell? Well, most of the bars are mostly below the moving average, like this. We're staying mostly below the moving average. Most of the pullbacks do not get far above the moving average. Most of the pullbacks only last 1, 2, or 3 bars. There are no consecutive big bull bars closing on their highs. Here, consecutive bull bars, not especially big. Consecutive bull bars, 4 of them, but not especially big and not all closing on their highs. Also, if you see a lot of stop entry setups and they all are losing money, then it's not good to be a stop entry buyer. I also look at breakout points. Here we broke to the downside below that area. This is the breakout point. This is the breakout. You have a better chance of making money selling if the pullbacks stay below the breakout point. Here, the pullback went above the breakout point. And when that happens, you will get some bulls buying below the prior low, looking for a scalp back up to the prior low, the breakout point. But sometimes you'll have a trend where the pullbacks do not go above the breakout points all day, and that is a very strong bear trend. If the pullbacks are reasonably big, the bear rallies are reasonably big, bulls can also buy. You need to see bull bars closing on or near their highs. It's better if you start seeing consecutive bull bars closing near their highs and above the moving average. If you see that, then the next buy setup that you see, it has a higher probability of being profitable. Here we have a breakout, but we have a pullback above the breakout point. So this is a bear channel, but I also refer to it as a stairs pattern. We're stair stepping down. And when you're in a stairs pattern, bulls will buy at the prior low and they'll buy more lower, expecting it to get back above that low. Still easier to make money selling rallies than buying breakouts. Breakout point, pullback, twice above the breakout point, and therefore limit order bulls who buy at or below prior lows are making money, and that will encourage bulls to buy at and below every prior low. Limit order bulls. They have a limit order to buy at that low or just below, and they buy more lower. Are the limit order bulls making money? They buy here, they might buy more a couple points lower, a couple points lower again, and then if it gets back to their original price, they can get out break even on their first buy and with a profit on their lower buys. This is something that only experienced, consistently profitable traders should do. Most traders in a bear trend should be only looking to sell. Blue box, you get out break even on your first buy and with a profit on your lower buys. Or if you don't take the first buy and you simply buy a fixed number of points below that low, you come out with a profit on your lower buys. Bear breakout, so a spike. I use the term spike to mean a breakout. We have a bear breakout, a pullback, and then a channel. So a spike and channel bear trend. 75% chance you're going to break above the bear trend line, break above the channel. Typically test the start of the channel and then enter a trading range. At that point, the market's in breakout mode again. Traders are looking for either a breakout to the upside or to the downside. We have a bull bar, but not a pullback. On a smaller time frame chart, maybe a pullback. But on this chart, it's not a pullback. A pullback means a bar that goes above the high of the prior bar. This bar went above the high of that bar. This is the start of a pullback. And the bears look for a reversal down from a pullback, and they sell below bear bars, closing near their lows. Big bear bar, around a 50% pullback. Bears will sell below a bear bar closing near its low, betting that we're going to form a series of lower highs and lower lows, a bear trend, a bear channel. Again, a bear channel, 75% chance of a bull breakout, and therefore it acts like a bull flag. Bear trend, tried to reverse up, but then we're getting a bear bar here. I always look to the left, and if it's a possible double top, this is a double top bear flag. If there's a bear bar here, I'd like to sell below that bear bar or this bear bar, because I know there's a 40% chance I'll break below the neckline of this double top and fall for about a measured move down. A double top bear flag. The biggest bear bar in the past 20 bars, the biggest bear bar late in a bear trend, it's probably going to reverse up. A bear break below a bear channel, 75% chance it's going to reverse up. Sometimes you'll get a small second leg down, but if you have a bear channel and a breakout below the channel, 75% chance you're going to get a reversal up to the top of the channel. I don't have the trend line drawn, but that's the minimum goal. And sometimes you get a bull trend reversal day like this. Big down, big up, failed breakout below the channel, a sell climax, probably will get at least a couple legs up. This is a possible low of the day. Reasonable to buy above a bull bar here, or wait for a second bull bar, or buy above any of these bull bars closing near their highs, betting that we might be in a swing up. I said if you have a bear channel, you have a 75% chance of a bull breakout. Well, you have a 25% chance of a successful bear breakout and the channel becoming an even stronger bear trend. So instead of a channel and then a trading range, we have a channel and then a bear breakout and then another channel. If it starts to break out below the bear channel and you see one or two big bear bars closing near their lows, traders will start to sell below the low of bear bars closing near their lows, betting that we're entering a breakout phase again, a strong bear trend, and we'll probably get a bear channel. Bulls are giving up, the bears are selling aggressively. This happens quickly. So do not be in denial. If you see a couple big bear bars closing near their lows, you sell with a stop below either of the bear bars, or you just simply sell at the market. Here we have a spike and now a channel. We're trying to break below the channel, and we have a pretty good bull bar. You're probably going to get some profit taking after a wedge bottom, and most bear breakouts below bear channels reverse. Here we have a very good looking buy signal bar, a bull bar closing near its high, decent sized body. We're probably going to go up for a couple legs, at least to the moving average. So bears would exit one tick above that bull bar, and bulls would buy looking for at least a test of the moving average. 4 different bear channels. A very tight bear channel, a micro channel. No bar goes above the high of the prior bar. So that is a micro channel. On a higher time frame chart, it is a breakout. It's a series of big bear bars. So this is an extremely strong bear trend. You only sell. You treat it like a breakout. It is a breakout on the next higher time frame chart. If this is a 5-minute chart, we have some little bull bars. On a 15-minute chart, you would have no bull bars. You'd have a series of big bear bars. Only look to sell. And then next we have a small pullback bear trend. The pullbacks are small, only last a few bars. This too is a breakout on the next higher time frame chart. A small pullback bear trend, pullbacks only 1, 2, or 3 bars, and they do not go up very many ticks. It's impossible to consistently make money buying. You should only sell. Treat it like a breakout. And here is just your ordinary bear channel. The legs up are pretty big. Bulls can make money, but it's still much easier to sell. Look to sell pullbacks to the moving average. Sell below a bear bar closing near its low, or reversal down from the moving average. And when you have these bull channels with reasonably good rallies, bulls will buy for scalps. Limit order bulls, they'll buy below bars. Stop order bulls will look for an occasional bull bar closing on its high far below the moving average, and they'll buy for a scalp. But still easier to make money as a bear selling below bear bars, reversing down from around the moving average. And then finally, you'll have a bear channel where we're getting lower highs and lower lows, so it's a bear channel, but it looks like a trading range. And for much of the time, it is a trading range. And in that kind of a bear channel, both bulls and bears buy and sell, but they treat it like a trading range and they take quick profits. So you buy low, you sell high, and you mostly scalp. It's basically a trading range that is tilted slightly downward. If most of the bars are mostly below the moving average, it's still going to be easier trying to look for mostly shorts, mostly looking to sell. Bear channel. A spike, 4 or 5 bars up, reversal down, 10 bars up, but we're forming lower highs, lower lows. Sometimes you'll get above one high, but not above other highs. It's still a bear channel. During the breakout phase, traders will sell below bear bars closing on or near their lows, so just sell at the market. Once you have a pullback, the market is now in a channel phase. It's still a bear trend. It's easier to make money selling below bear bars, especially at the moving average, but you can sell below any bear bar if you use the appropriate stop. A rally that lasted more than an hour, but look to the left. It might be a double top. A little bit higher, but still a double top. And there's also 3 pushes up, and that is a wedge. So you get a wedge rally to a double top, not much above the moving average. Traders will look to sell a reversal down, either below this outside bar, or because this bull channel is tight, they might wait for a second sell signal below that bar or below any of these bear bars. Rally for another hour, look to the left, possibly a double top. traders will look to sell a reversal down. We have a micro double top, up, down, up. They could sell below the neckline, this bear bar, or sell below that bear bar. Now, we have a new low, but the reversal up went above the breakout point. So it's a stairs pattern. Bulls will buy at prior lows, and they'll often buy reversals up with stop orders, like here, and then here. A second entry buy first, and then a second buy. Bear channel, the bulls are only scalping. As long as we keep making lower highs and lower lows, the bulls are only looking to scalp. Wedge, 1, 2, 3, and a parabolic wedge. We're probably going to get a couple legs up, reasonable to buy with a stop above that bull bar. Bears look to sell rallies to around the moving average, or rallies that retrace about half of the last bear leg. Because it's in a bear channel and we keep making new lows and lower highs, the bears can swing trade, so they can take that sell and hold through this rally if they want and just rely on their stop, or they can sell, take a profit around a new low, and then wait for the next rally and sell again. The bulls are only scalping. The bears can swing trade or scalp. Easier to make money as a bear, more sell setups than buy setups, and if you trade properly, your average profit selling is greater than your average profit buying. Here, we're having a bear breakout, but it's really not all that strong. However, it still could be the start of a bear trend. Look at this. 7 bear bars closing near their lows, not much overlap. This is a strong breakout. This is more likely the start of a bear trend. So we might get a spike down, a pullback, and then channel down. It stayed below the moving average. Bears keep selling. Every time you get a rally and then a bear bar closing near its low, especially near the moving average, traders will sell with a stop below the bear bars closing near their lows. They'll also sell the close of big bull bars in the pullback, betting that the breakout attempt will fail and the bear trend will continue down. So they can sell with a stop, the red rectangles, and they can sell the closes of big bull bars near the moving average. Finally, they can simply place a limit order at the moving average and sell at the moving average, expecting a new low. In a stairs pattern where the pullbacks overlap the breakout points, the bulls will buy, or some bulls will buy, bull scalpers. For example, they'll buy at the prior low and then scale in more, 1 or 2 points lower, expecting it to come back here where they can get out break even on their first trade and a profit on their lower trades. Sometimes they don't take the first buy, but they will buy 1 or 2 points down, expecting the pullback. They want to see stairs. They want to see pullbacks going above breakout points. And once they start to see that, you will get limit order bulls buying below prior lows looking for scalps. Beginners should not be doing that. It's very hard to buy that low and see the market do this and then buy more instead of exit. So emotionally very difficult for beginners, and they should not be doing that. The bulls who do it, they get out once the market bounces back to their original entry price at the prior low. So scalps all day long if you have a stairs pattern. This is a relatively small pullback bear trend, so very difficult for bull scalpers to make money, much easier to make money looking for sell signals. A lot of prominent tails, a lot of overlap. we have a new low and a bull bar, bulls will buy, looking for a scalp up. If it's pretty easy for stop entry bulls to make money, you're probably going to get some kind of a reversal by the end of the day. The bears will take profits, not expecting the day to sell off into the close. They're happy to have their profits, they'll take their profits. We also have 3 consecutive wedges today. Wedge bull flag. We have a rally, possibly a bull flag, high or low, did not reverse up. A second wedge, a third wedge. Eventually, you have to bet the bears will succeed, especially when the bodies are small and you have a lot of prominent tails and you have a lot of bull bars. Here you have 5 consecutive bull bars, 3 consecutive bull bars, 4 consecutive bull bars. So the bulls are in control for a long time and repeatedly, and stop order bulls are making money. Bulls, at the end of the day, the final hour, are ready for possibly a swing up. They look to buy for a swing up. Tight bear channel. In this particular case, we have a bear reversal, a double top bear flag, and then a very small pullback bear trend. 6, 7, 8 bars without a pullback, and then the pullback is only a little bit. Pullback only 1 bar. Small pullback bear trend. This is a breakout on a higher time frame chart. You should only be looking to sell. The bulls cannot make money even with limit orders. That means it's a very strong bear trend, and it's a breakout on a higher time frame. You have to get short. You can sell for any reason, and you do not look to buy. How do you get short? Easiest thing is look for a bear bar closing on or near its low, and either sell the close or sell using a stop 1 tick below its low. Increasingly steep bear trend, so it's a parabolic bear channel, and it's a spike and channel bear trend. Spike down here, and then a channel here, parabolic channel. Very tight bear channel, very small, very brief pullbacks. Only sell, and you have to sell. For any reason, you got to sell. Sell below any bear bar closing near its low. Below this bear bar, below that bear bar, below this bear bar, below that bear bar. Just sell and hold for a swing down. Again, when you have a small pullback bear trend, the pullbacks do not go up very far. They do not last very long. If they last a few bars, they still do not go up very far. You just sell below any bear bar, especially a bear bar closing on its low, betting on a swing down. You can even just simply sell at the market. Also, the pullbacks are small. You expect them to last only 1 or 2 or 3 bars, and therefore you can sell above the high of any bar, betting that the reversal up will not get far. In addition, anytime you see a bull bar, you have to assume the reversal will fail, and therefore you can sell the close of any bull bar. Broad bear channel. The rally retraces most of the prior bear leg. We're trying to break above the moving average, and we failed. At a lower high, this might be either a trading range, which it was for most of the day, or a broad bear channel, lower high, lower low, lower low. Most broad bear channels spend a lot of time in trading ranges, and you trade them like trading ranges. You look to buy low, you sell high, and you scalp. It doesn't matter if you think of it as a broad bear channel or a trading range. You trade them the same. They often look very bearish near the bottom and very bullish near the top, but that's the exact opposite of how to trade them. You do not want to be buying high. You do not want to be selling low in a trading range or a broad bear channel. A broad bear channel behaves more like a trading range than like a bear trend. You trade it like a trading range. Buy low, sell high, scalp. Second signals are good if you get double tops near the top, double bottoms, micro double tops, micro double bottoms, wedge bottoms. They're all higher probability entries. Here, a wedge top and a second entry sell. A double top and a small wedge, sell below the bear bar. Tried to reverse up a second time. It's a high 2, a micro double bottom, and it's a big double bottom. That's a reasonably good buy. Parabolic wedge, 3 pushes up in a tight channel, also near a prior high, so it's a big double top, and we have a micro double top. Up and down, that's a good sell. A double bottom, higher probability buying above the neckline, or even above this bar for that matter. Another parabolic wedge, sell below the bear bar. Lower high, parabolic wedge. We have a failed breakout below a double bottom. If you want, you can call it a double bottom. You can call it a big high 2, high 1, high 2. A doji bar, you can buy above the doji bar because it's a high 2 and a double bottom, or you can buy above a bull bar closing near its high. I want to review what I just went through. Sometimes you'll have a bear channel with no pullbacks. Every bar has a high at or below the high of the prior bar. It's a breakout on a higher time frame chart. You trade it like a breakout. You only look to sell. Easiest way to do it, just look for any bear bar closing near its low and sell the close or sell just below the low. Sometimes you'll have a tight bear channel where there are pullbacks. This is a small pullback bear trend. On a higher time frame chart, it's also a breakout. And if the pullbacks are small like this, it's better only to look to sell. Again, if you have any kind of a pullback, 1, 2, 3 bar pullback, wait for a bear bar closing near its low and sell with a stop below the low of the bar. Other times you'll get pullbacks that last 5 or 10 bars, and every new low, traders buy it. This is your typical bear channel. Stop order bulls will look to buy above decent bull bars, far below the moving average for a scalp. Limit order bulls will buy at prior lows and buy more lower. Easier to make money only looking to sell. We keep reversing at the moving average. When it's at the moving average, look for a bear bar closing near its low and sell below the bear bar. And finally, sometimes you'll see a broad bear channel where it looks like a trading range, but it's still forming lower highs and lower lows. You can buy low, sell high, and scalp. Because it's a bear trend, it's in general slightly easier to make money selling, and it's better to focus on selling. I began by talking about a bear channel. A bear channel is simply a bear trend that has a series of lower highs and lower lows. And then I talked about how to trade bear channels. Next, I moved on to talking about special types of bear channels, like very tight bear channels, small pullback bear trends. You treat them like breakouts and you only look to sell. And finally, I talked about broad bear channels, which are basically trading ranges that are tilted down, and you trade them like trading ranges. You look to buy low, you sell high, and you take quick profits. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is a bonus video on trading bear channels.